would like to welcome you to our transfer pricing webinar of today. So if we look at the last couple of years, the tax landscape in the GCC region has changed dramatically. We have now 4 out of 6 countries which have corporate income tax, and the remaining 2, Bahrain and UAE, are actively discussing to implement the corporate income tax as well. Also, 4 now out of 6 members have introduced VAT, and the next will likely be Qatar. And also excise taxes have been implemented in all member states, and currently the discussion is around even extended these excise taxes. So one could ask the question, why is this the case? Why so many new taxes come to the regions and are implemented here? So first of all, of course, the government wants to ensure that they have also other sources of money than only oil and gas. However, and I think this is probably especially valid for Qatar, even more important is the relationship between OECD and the EU, and their Qatar and also other GCC countries, they want to avoid to end on a blacklist. And in connection with this relationship, more and more reporting requirements have been introduced. And the tax authorities also, has started to ask more and more questions. And you all can easily see that there are a lot of assessments ongoing and a lot of discussion also around transfer pricing. And this is exactly what will be, so transfer pricing, what will be the content of our webinar today. So before we start, I would like to just shortly mention some administration things. So first of all, please be aware that this session will be recorded, and you will receive the recording within approximately 2 days from now. Second, we have counted in enough time for your questions. So please make sure that your questions are of general nature, so we cannot answer questions who are very specific to your case. And also please make sure that you type in the questions at the right-hand side of your screen. There you will find the Q&A or a chat box. Please enter the questions there, and please make sure that you address the question not to the host, but to all panelists, because otherwise we cannot see them. And last but not least, we would love to receive your feedback after our session. So you will receive a short questionnaire, and it would be great if you could fill that in. So with that, I would like to present the speakers of today. We are very proud that with Philip and Ramya, we have 2 members of our regional transfer pricing team. They are both, very experienced transfer pricing specialists, and they support us here in Qatar. With us, I mean our transfer pricing team, which is led by Uma, and you all have already probably heard Uma in other sessions. So with that, I would like to hand over to Philip directly. Thanks a lot.
Barbara, and thank you everybody for attending this webcast. Now, before we jump on the kind of Qatari specific regulation, I just wanted to do a little bit of background of what is transfer pricing. When we have transactions between related parties, and by related parties, we're going to discuss it a little bit later on what it is, but let's say it's by members of an international group of companies, so by different subsidiaries of the same group. Transactions that the group entities are having between each other are something which is referred to as controlled transactions. Why controlled transactions? Well, because there might be conditions imposed on the entities of the same group which would distort the pricing which is applied, and which would be resulting in a price that is different from a market price. Now, why is this important? Is with controlled transactions or intercompany transactions, there is a huge possibility of shifting profit from one location to another, perhaps from one location that has a higher tax rate to a jurisdiction that has a lower tax rate. Transfer pricing has historically been the most significant source of tax avoidance and tax evasions. And it applies to all categories of transactions, whether it is tangible, intangible goods, services, loans, financial transaction, etc. Because of this profit shifting potential, the OECD and tax authorities worldwide were very focused on transfer pricing over the years and have been increasing the burden on multinational companies or increasing requirements to ensure that profits are located in adequate jurisdictions. Now we have the OECD BEPS action, which continues to increase focus, especially on substance during the last year, but we now also have focus on digital economy and the split of profitability for, let's say, new players or the tech companies. Locally, jurisdictions are implementing transfer pricing rules, which for taxpayers may result in tax adjustments, in penalties, and increased risk of litigations. Therefore, companies are encouraged to do a transfer pricing analysis. But when we're talking about transfer pricing analysis and how do we analyze these controlled transactions in order to assess whether we have certain tax exposures, if we can go to the next slide. It is a kind of whole process which starts off identifying the terms and the conditions of the controlled transaction. So what is the characteristic of the property or of the service or of the financial transactions that we're analyzing? Then usually we start with identifying contractual terms of the transaction, seeing what kind of allocation of risks is contained in the contractual agreement, and verify whether it reflects with the substance of the transaction on the ground. Then we also have to identify kind of a wider setting on which this controlled transaction is taking place, because there might be differences in various industries on how transactions are structured. A business strategy can also have an impact on the pricing of the controlled transaction, on whether it is in the startup phase, whether the company is expanding, or whether the company is in the defensive position. And finally, there is a need to understand who are the entities which are involved in a controlled transactions and what is their roles and responsibilities. Usually this is done by conducting a functional analysis where you would analyze the functions, assets, and risks which pertain to controlled transactions and how they are allocated between various participants to understand what is the profit, what is the characterization of the entities, and to what kind of remuneration they should be entitled. When you understand a little bit more in depth on what is the nature of the controlled transaction and its participants, then you can proceed to the selection of a transfer pricing method. Now, there are various methods. Historically, and very relevant for Qatar, is the comparable uncontrolled price method, where you basically compare prices which are available externally. I'll use an example of commodity pricing or oil pricing, which are available in various stock markets and are actively traded, so you can get a reference point. Then we move to some traditional transfer pricing methods, which are the resale price and the cost plus method, which are more gross margin methods. So a cost plus for manufacturing or the cost of manufacturing activities, resale price, which would give you an indicator of a gross margin. And they have their application points. But nowadays, more and more companies, or more and more kind of companies, when doing transfer pricing analysis, are focusing their efforts on transactional profit methods. For example, the transactional net margin method, where the entity's profitability would be analyzed depending on a different profit level indicator, but usually on an operating margin. Finally, in certain cases, there's the profit split methodology, where both sides or both related parties in the controlled transaction contribute with some unique and valuable contributions, like intangible assets, in which there is a methodology that can put in place that splits the profits. So it is a kind of full circle that you have to take a look at the terms and conditions, identify the broader environment, select the transfer pricing method, and only then you can apply the transfer pricing method to your control transaction to understand what the market pricing would be and to see if your market pricing or if the price that you have applied is coherent with the transfer pricing. That said, I'm going to hand it over to Uma to go over to a little bit details on what are the Qatari transfer pricing regulations. Uma, up to you.
Thank you, Philip, and hello, everyone. We'll now try to do a quick recap on the Qatar transfer pricing regulations and legislation and try to capture a few key aspects around these legislations. So when we talk about the transfer pricing legislation, what do we really refer to? The first point of reference would be the executive regulations, which were issued in December 2019. These regulations provide the framework provisions for the application and administration of transfer pricing regulations in Qatar. The specific transfer pricing documentation and compliance requirements have been introduced and are enforced under these regulations. In addition to the regulations, we also have the resolution number 4, which was recently issued by the tax authorities. This resolution provides the guidelines on the application of the transfer pricing regulations, focusing on the deadlines, thresholds, and content requirements for each of the reporting requirements in Qatar. Now, when we look at the executive regulations and resolution, we also need to bear in mind the Dariba system itself and the interface and programming of the system, because that could determine how and what information is being submitted. Besides these three, we also look forward for the frequently asked questions to be issued by the tax department. We do understand that the authority, they do intend to issue these frequently asked questions. We still wait for that. But as soon as these are issued, we'll ensure that we keep you informed and updated. Now let's move on to look into the executive regulations and understand the key features of these regulations. So the first being the transfer pricing principle. The most important thing to note here is that the arm's length principle per se has been part of the tax regulations and the tax law ever since 2010. The taxpayer is required to comply with the arm's length principle and with the transfer pricing regulations when they enter into transactions with related parties. The taxpayers are expected to determine the arm's length pricing ideally at the time of entering into the transactions and latest by the time of filing the tax return. The new executive regulations also expect the taxpayers to maintain some level of functional and comparability analysis for all related party transactions, and this could apply also to taxpayers who would otherwise fall below the reporting thresholds. Now, when we look at comparability analysis, the important aspect there is that the comparable uncontrolled price method is considered as the preferred method in the regulations. So a taxpayer will be able to use the other OECD methods that Philip explained just a while back. However, in order to use these methods, the taxpayer is expected to file an application requesting the authorities to allow the taxpayer to use the different methods. When we look at reporting, this is of course the key highlight of the new executive regulations, because it is with this that we have, for the first time in Qatar, specific transfer pricing compliance requirements. And by that we mean first is the Transplacing Declaration. The regulations confirm that these need to be filed with the tax return if the specified thresholds are met. Then the master file and local file will also have to be filed by a specified due date if two conditions are met. One, the thresholds are met, and secondly, if at least one of the related parties of the taxpayer is not resident in Qatar. The executive regulations also provide the ground rules for assessments. You could expect a detailed questionnaire being issued by the tax authorities focused on transfer pricing. The tax authorities will definitely have the right to ask for additional information as well as backup documentation to confirm the arm's length pricing of the related party transactions. Now let's look at another key feature that is the definition of related parties for the purpose of transfer pricing regulations. Now, in most cases, when you look at global regulations, there's always a specific definition provided in the tax law for related parties and to be applied in perspective of the transfer pricing regulations. However, in Qatar, there is no specific definition. There is rather a direct linkage or reference made to the meaning provided by the international accounting standards. So primarily, we are looking at the IAS 24. And this means that a significant reliance will be placed on the disclosures in the financial statements, and taxpayers will have to ensure that the reporting in the TP regulations, under the TP regulations, is aligned with the disclosures in the financial statements. Now, when we look at the definition of related party per se, this covers not just the parent and the subsidiary, but also covers an associate, a joint venture, or an entity that could have a direct, indirect, or common ownership of at least 20%. It would also include individuals and close family members of such individuals who would have a significant influence on the control and management of the taxpayer. So per se, we look at a very broad definition of related parties when we look at IAS 24. Now let's do a quick recap on the resolution number 4. If you could move to the next one. Yeah. We've discussed this in our earlier webinar, and we just want to retouch on this, that the main aspects of the resolution number 4 is the thresholds and the due dates on the various compliance requirements, starting with the transfer pricing declaration. So these will be applicable for taxpayers where the total revenue or the total asset cross 10 million Qatari riyals. The TP declaration has to be filed along with the tax return. So in a normal situation, this would be 30th April. And the reason for this is that the tax return cannot be filed without the declaration if the declaration is applicable. So the filing will have to be done in parallel. However, this year, given the extensions that we have, 30th April will remain the deadline for all the oil and gas entities. But for all the taxable entities, the deadline will be 30th June, and all the Qatari and exempt entities, it will be 31st August. Now, when we look at master file and local file, there is a common threshold and common deadline. So these filings will be required if the total asset or total revenue of a taxpayer crosses 50 million Qatari riyal. Now, the resolution says that the additional requirement over here is that if one of the group entities is resident outside Qatar, then this filing will be applicable. Now, when we look at the deadline, the resolution specifies 30th June of the following year, of the following financial year, as the deadline for filing these files. Here, we don't have any specific information on extension, and until we have specific instructions from the GTA, 30th June will remain the deadline for filing the master file and local file. The important aspects of the master file and local file is that the master file is prepared at the group level and usually prepared and maintained by the group. However, the taxpayer, the local file is to be prepared at the entity level, focused on each taxpayer. Now, let's look at the content requirements for each of the submissions. So first is the transfer pricing declaration. This covers information in summary, and the information here is on the main activities of the group, the group transfer pricing policies which are being applied to the taxpayer, the group intangibles that are being used by the taxpayer. It also provides transactional information for each type of transaction. What is important that the specific transfer pricing method, so the most appropriate transfer pricing method is specified in the declaration. Here, the important point to note is if a particular category of transaction or type of transaction is below 200,000 Qatari riyal, then such transactions could be excluded from the reporting. Now, the TP declaration doesn't per se ask the taxpayer to confirm that the pricing are at arm's length, but there is an underlying understanding and expectation that if there is no adjustment in the tax return, then the taxpayer is basically confirming that the related party transactions are at arm's length. Now let's look at the master file. Like we mentioned earlier, master file is prepared and maintained at the group level. So it will talk about the business activities of the group, the underlying value drivers, the associated supply chains or process flows for each of the group activities. It will focus on the functional analysis around these activities. It will also talk about the group intangibles and what are the intercompany agreements on the use or transfer of intangibles within the group. It will also focus on intragroup financing. So how are the entities financed within the group, and what are the transfer pricing policies being applied for intergroup financing. When we look at the local file, that focuses on the taxpayer. So it will talk about the business activity of the taxpayer. It will talk about the management structure of the taxpayer, what are the key competitors of the taxpayer. It will provide details on the related party transactions entered into by the taxpayer. It will document the functional analysis for each of these related party transactions. It will document in detail the comparability analysis that has been undertaken to determine the arm's length pricing for each type of transaction. And also, of course, the conclusion on whether the related party transactions are effectively at arm's length or not. So these are the content requirements as per resolution number 4. Now, when we look at the executive regulations, the resolution number 4, and when we understand the Dariba interface, we do notice that there are some aspects where there could be some discrepancies in the interpretation. We've tried to bring out a few examples to show you how these discrepancies could arise. And the first example that we've taken is of the TP declaration and the very first information requirement in the declaration. So the resolution number 4 asks you to provide a brief description of the group activities. So the business activities of the group. However, when you try to file in and fill in this information in the Dariba portal, what is available over there is a pre-populated list of the activities of the company. And this list is linked to the commercial register of the company, commercial registration and license of the company. So while the question is focused on the group activities, you're forced to provide an answer on the activities of the company. And the issue over here is sometimes the activities of the company may not be a good representative of the group activities. Secondly, the Dariba system does not provide you the flexibility to add more activities over there. So in principle, we do see a disconnect here between the question that is being asked in the resolution and the answer that you would be providing through the Dariba program. Now, the next example that we've looked at is the master file. We've already seen that the executive regulations specify that both the master file and the local file filing will be required if at least one of the related entities or related parties is resident outside the state. When you look at the resolution, the terms used here are if one of the group entities is outside the state. And then when we look at the Dariba, the question being asked is, do you have a related party that is abroad? So while these terms may seem, seem to be interrelated or could be, replaced, the interpretation is actually different when you look at certain situations. So let's look at a joint venture situation where a joint venture is being formed by a local Qatari shareholder and a foreign shareholder. However, this joint venture is not being consolidated in either of the groups. It's not part of either of the groups when you look at each of the shareholders. So as such, it's a single entity. But if the question being asked is, do you have a related party outside? Then the answer is yes. And then there is a requirement to file a master file. But in the master file, what would be the reference to the group? Because the JV doesn't really form part of any particular group here. And then what would be the contents of this master file? The second example that we have is, if you look at a pure Qatar-based group where the head office and all the entities in the group are all resident in Qatar. So if you focus on the definition of group entities, there is no group entity that is outside the state, that is resident outside the state. However, if the question being asked here is, are there related parties outside the state, this could have a different impact. So if we assume that one of the key influential directors has a personal venture outside Qatar, and such venture would then form part of the related party definition for the group, then would you say that the group and all the entities in Qatar will have to prepare a master file and local file, even though the entity that is outside is not really part of their group? So we do hope that once we have the FAQs, we'll have more specific direction on the requirement of the master file. And if in case such direction is not provided, then of course the taxpayers will have to determine what would be their stand when they do the master file reporting. When we look at the local file, again, there is an interesting aspect over here. The question being asked is, do you have a related party abroad? So it is focused on the presence of a related party abroad rather than existence of related party transactions. So you could have a taxpayer which has related parties outside Qatar, but does not really have any related party transactions. So in such case, a local file reporting will then be a mere compliance requirement without any specific analysis covered in such a local file. Then let's look at the other key aspects around the application of the regulations. We've already discussed, the fact that the definition of related party is broad. We've also discussed about the group and non-group implications. The other aspect is that the transactions with the key managerial personnel is also going to be covered under IAS 24. Do they then be covered under TP regulations? The next question that arises is on the due date. So when we look at the master file and local file, the due date is a specific date, that is 30th June of the following financial year. So of course, this creates ambiguity when you look at taxpayers that have different year end. And already the situation that we are looking at right now is when you have extensions in place for filing the tax returns, it's not clear whether the master file, local file filing would be extended. The other issue is on the timing. So the date specified is 30th June in Qatar. And when we look at most of the groups, they usually plan for a 31st December deadline for preparing, let's say, a master file. So such groups will have to now rework their timelines to ensure that they are able to comply by 30th June in Qatar. The other administrative issue in master file and local file submission is that it's not a single click of a button, uploading of a document, or just submitting a document. The Dariba portal and the programming expects itemized filing of the master file and local file. So each category or each item will have to be submitted separately. So this definitely increases the administrative burden for the person who would be doing this filing. So while we've been focusing on the issues and the practical aspects that we see in the Qatar regulations, there are of course some common concerns that could apply globally and equally to all entities. The first one is confidentiality. With the introduction of master file, you now have a issue that all the group policies, the group strategies, transfer pricing policies will be available not only to all the group entities, but to all the tax jurisdictions where a group operates in. The other issue is that when you look at a document like master file, it requires involvement of the key stakeholders within the group, which could be of challenge in some cases. And the most practical challenge that you would face is availability of data when you're looking at a comparability analysis to be done. So what would be the best data to be used? Would this data be available? Would this data be reliable? These are the questions that would come up when you're doing a comparability analysis. So with these aspects around the implication and interpretation of the regulations, I'll now hand over to Ramya to take us through some case laws and some specific transactions from a transfer pricing perspective. Thank you.
Thank you, Uma, and hello, everyone. So let's start with the case studies. In this first case, we will look at the TP aspects for a Qatar-based distributor. ABC Qatar LLC, the taxpayer under consideration, is jointly owned by ABC HQ LLC UAE and XYZ Qatar exempt entity. ABC HQ LLC UAE, as the head office, performs all significant functions pertaining to group strategy development, preparing marketing guidelines, and undertakes group HR, accounting, and other corporate support services. ABC Procurement Oman functions as the procurement entity, while ABC Qatar LLC operates as a distributor. The taxpayer needs to first identify the related parties and the intragroup transactions which would fall within the purview of this analysis. Given the shareholding, ABC HQ LLC UAE, ABC Procurement Oman, and also XYZ Qatar exempt entity would all be related parties for ABC Qatar LLC. Now let us look at the TP considerations for all the intercompany transactions undertaken by ABC Qatar. The first transaction relates to purchase of goods by ABC Qatar from ABC Procurement for further resale in the market. The degree of functions, risks, and assets of Qatar entity would determine the remuneration to be earned by the entity for the distribution activity. While undertaking a comparability analysis in itself is a detailed process, we will try to cover the key aspects here. First being the application of the transfer pricing method. In order to apply CUP method, for instance, the Qatar entity or the Omani entity would be required to purchase or sell similar products from or to unrelated parties. Alternatively, there needs to be information in public domain on similar unrelated party transactions. It is not common to have such information available to reliably apply CUP. Accordingly, we need to then evaluate the applicability of other prescribed methods based on the availability of data. Either resale price method, which relies on gross margin data, or transactional net margin method, which relies on the net profitability of an entity, may be suitable in these circumstances. A benchmarking analysis is undertaken using an external database to identify independent entities undertaking similar functions. And after undertaking a detailed analysis, a range of acceptable comparable margins is established. The profitability earned by ABC Qatar needs to be in line with this range for it to be at arm's length. In the second transaction, ABC Qatar makes a payment to ABC HQ UAE for head office support services. We need to first determine whether an intragroup service has actually been provided before proceeding to determine the arm's length consideration for such transactions. While the HO support services may be considered as services, there are considerations for duplicated activities, incidental or direct benefits, shareholder costs, which also may have a bearing on this. Having determined that a service has been rendered and that a charge should be made, the second step is to determine the appropriate quantum of the charge, which is consistent with the arm's length principle. In general, large MNEs use a direct or an indirect method for charging for services. While direct method may be straightforward, the indirect method is where the charge is based on an apportionment of a cost pool amongst various group affiliates. The apportionment will involve the use of allocation keys such as revenue or headcount for each cost head separately. Next comes the method to be used in determining the arm's length transfer pricing for intragroup services. In this example, assuming the head office is not rendering similar services to unrelated parties, CUP may not be an option. In practice, it is common to use cost plus method or transactional net margin method for services. While suitable markup is considered a common issue, there can be much more at stake when it concerns the cost base. Generally speaking, the cost base should include all relevant costs, not just the staff costs, but also, say, staff benefit costs or overheads such as rent, HR support, IT support, etc., which should all form part of the cost base. This can often make a much bigger difference than just an error in the markup. Finally, while markup is based on the nature of services being rendered and needs to be benchmarked against those earned by comparable service providers, international guidelines such as OECD TP guidelines provide for a standard markup for an elective, simplified transfer pricing approach for low and routine value-added services. The benefit of this approach is that it will reduce compliance effort and cost providing greater certainty to the group. In summary, the HO cost allocated by UAE to group affiliates would need to take into account all the above aspects into consideration. The final transaction involves payment by ABC Qatar to XYZ Qatar exempt entity on account of sublease payments and other admin support fees. Qatar TP regulations aim to cover domestic transactions. Arm's length nature of this transaction is specifically important due to the profit shifting possibility to the exempt entity. To the extent information is available with the Qatari exempt entity for comparable pricing, this should be used. For instance, where the property is owned by the Qatari exempt entity and information can be shared with respect to the use of this common facility. Now, this sums up our discussion on the first case study. ABC Qatar is required to report all intercompany transactions and maintain sufficient documentation to support the arm's length nature of its transactions. We now move on to the next case study. In the second case, let us look at the project branch structure. This is a common structure observed in the region, including in Qatar. Multinational groups, in order to participate and execute big infrastructure engineering or oil and gas projects, are required to set up local project office or branches. While the HQ would enter into agreement with a third-party customer, the branch is responsible for rendering services on the ground. However, historically, we have seen revenues being recognized at HO level and only costs are booked at the branch level, resulting in huge losses being booked at the branch levels. OECD provides specific guidance on attributing profits to permanent establishments. In that, the branch is treated as a legal entity separate from the head office for the purpose of undertaking the TP analysis. While Qatar tax laws made a reference to arm's length principle since 2010, this was rarely administered by tax authorities and no attention or rare attention was paid by taxpayers on this matter. With the introduction of formal TP regulations, it is critical that specific attention be given to the profit and cost allocation mechanism by appropriately remunerating the head office and the branch for their respective functional profile. That is, the functions performed, assets used, and risks borne by these respective entities. Additionally, other transactions between the branch and the HQ, such as royalty payments, interest payments, etc., are also required to be evaluated from a transfer pricing perspective. While it remains to be seen how tax authorities would perceive the historical losses incurred by branches, a robust transfer pricing documentation clearly defining the functional profile of the HO and the branch, which forms the basis for the remuneration split between HO and the branch, would serve in this stead. With this, I hand it over to Philip. Thank you.
Thank you, Ramya. Well, I think that what we wanted to go is to cover a little bit the topics on the actions required for business and what do you need to do. By hearing all of these things about transfer pricing, that I think is much more complex that needs to be that people had in mind. If we go to the next slide, If we talk about transfer pricing, I think that a lot of people think that it's a tax kind of thing. We just need to set the transfer pricing policy. We need to prepare a TP documentation, and the tax department has to kind of respond to queries by the tax authorities. But I think it's a little bit wider than that, even in the background. If we can go a little bit further, we're going to see that there is also the financial and accounting consideration, because tax is only the result. So the question is, how do you calculate, how do you report transfer pricing and transfer prices for the intercompany transactions? How do you manage the entity profitability for a case of the distributor? And what kind of journal entries and analytics are you doing? Because these are the key components that are going to be driving the reporting factor. Then you go into consideration of the ERP, and basically, how do you determine the transfer pricing? So are you going to have some sophisticated, perhaps automated process on how your ERP operates, or you're going to be relying on Excel tables and kind of things? If we could just move to the next circle as well. So there's this ID component that we have to understand how the data in respect to control transactions is organized and is represented throughout the organization. So there is this financial component on how do we determine that comes to the tax practice. Then I think that there is a lot of interplay with other tax forms. When we talk about distribution and the importation of goods, we have customs. Now you have what is called a year-end adjustment that you might be making, that you will have a corrective invoice to bring the profitability of the company up and down. And if you are importing goods, you have to have a year-end adjustment invoice, this might impact the customs value that has been given. What do you have to do with this? Can you change the customs value? Can you reclaim the customs that are bringing back? How do you track the changes? How do you have this link between the custom supply chain department and the tax department? And what do you do in cases that you have kind of different valuation methodologies that are applicable in transfer pricing and in customs? You also have the same thing, I think, for intercompany services, where you have withholding tax consideration that may arise in case of adjustment. So I think the transfer pricing is really integrated in the operations of the business, and it has to be looked at from multiple dimensions in order to be properly managed. This is what we call operational transfer pricing. So my point here is just look at the other dimensions apart from the transfer pricing documentation. If we go and discuss what I would like everybody here to take as actions on going forward, I think that the first question that you need to ask yourself is, are your transactions for 2020 at arm's length? This is the crucial point that I think every company that has controlled intercompany transaction should be able already to respond. You have to look at the filing requirements and whether you are falling within the kind of thresholds and obligations, and to inform various stakeholders on what transfer pricing is, so that they have that note of intercompany pricing and that they come to the tax and finance team, which are managing this. As a finance team, you have to stay updated with the developments, and you have to kind of follow these applicability criteria. So what are the related party definitions, follow on the revenue thresholds, and be aware of what the intercompany flows are, because not all kind of my clients are even aware of the quantum of intercompany transactions that they have and the volume and the exposure that they. When you identify those things, well, then there is the kind of documentary part which is there. And by documentary part, I don't think only transfer pricing documentation. Usually in a transaction, we start from an agreement which should be covering the transactions. Then we're usually following a transfer pricing policy where we're setting the ground rules, procedures, and methodology to apply pricing on these transactions. And then we have proper invoices which have proper supporting documentations. Or in case of services, engineering services, management fees, and head office allocations, we have emails or supporting documentation that will prove that the service was actually rendered. And finally, we go to the thing of where disputes arise and when controversy takes place. Do we have a risk matrix to understand the kind of level of exposure that we're having, and how do we track the potential of transfer pricing adjustments? Are we ready to engage into disputes, and do we have a strategy, a defense strategy on how we're going to support the prices? So I think that action for businesses, it is already very close to 30th of June 2021. 2020 has already passed. I really hope that a lot of you have taken a look at this. And as we are already at the end of April, 2021 is ticking fast. So I think that there is kind of immediate actions for business that need to be done, especially because we're in the first year of implementation in Qatar. So it should be on your radar. Now, that said, I think that this is it from kind of our perspective. And now we're going to pass on to the Q&A and to discuss your areas of concern.
So if you have further questions, of course, please feel free to put them in the Q&A session or in the chat, but we have already received quite some questions. So first of all, I think, Philip, is TP declaration, has it also to be filed by fully GCC-owned or Qatari-owned companies, or are they exempt?
Yes, and I think that this question comes from perhaps Saudi, where local Saudi entities, which are zakat paying, have exemptions in terms of these disclosure forms. This is not the case in Qatar. There is no exemption available for anybody. So whoever meets the threshold, irrespective of their ownership and kind of whether it's GCC or non-GCC, will fall within these requirements. So it's a very broader scope of data that's going to be necessary.
Okay, maybe the next question, I think Uma, probably you could comment. So we have quite some participants asking whether we could not, just send them the file format for the master and local file that they can somehow prepare.
So it's important to note that master file per se or local file are not forms similar to the declaration. They are instead you would look at them as reports where detailed descriptions and analysis are captured. So you couldn't, they cannot be called forms, and they couldn't have a very specific, kind of a template that you could draw out for a master file, local file. So we would say that it cannot be looked at as a form really. I hope that answers the question.
Okay, maybe the next question, I think, Ramya, if there is a transaction between GV Qatar and the branch in Qatar, does this transaction need to be reported?
This brings us back to the discussion where domestic transactions are also covered within the Qatar TP regulations. And if the JV Qatar and the branch, fall within the related party definition scope and are reported in IAS 24, then they will have to be covered. I hope this answers your question.
Maybe the next questions to Philip. What happens if one related party incur expenditures on behalf of second related party and later on back charge to the second party without any markup?
I think that this is something which is referred to a pass-through cost in general.
Yeah.
It has to be analyzed in kind of further details. I don't think that there is any exemption which is available for this in kind of non-reporting or non-including it in your local file. But if the facts and circumstances of the transactions are such that it is actually a pass-through expense, it may be that there is no additional markup necessary because it is just a routing of expenses. Sometimes we do observe there is a small cost component added for the kind of processing of these invoices in just the routing, but it depends on the materiality thresholds and the actual point.
Okay, maybe the next one to Uma. What about the overhead expense allocation based on the Qatar tax law between branch and in Qatar and the head office?
So the overhead charges also will be covered for the reporting, simply because the base principle here is it is still a related party transactions. And even if you're looking at an HO and a branch being part of the same legal entity, there are still two separate taxpayers in two separate jurisdictions. So these would still be covered for TP analysis, and of course, in the basis of determining the cost and the allocation will have to be understood and analyzed. Yeah.
Okay, I think the next question, I think Ramya, it's about, is it possible that the deadline for the Qatar filings will be extended? Or Uma, I think whoever wants to, sorry.
I think I'll take this question. So like I said, that as of now, there is no specific guidance from the GTA or instruction from the GTA on the extension. The other aspect is when they talk about the deadline, they don't say that it is 2 months after the deadline of filing the tax return. The resolution says 30th June as a specific date, So you cannot assume that just because the tax returns have been extended, the filing for master file and local file will be extended automatically. We do need specific instructions from the GTA for this. And until that comes in, we'll look at 30th June as the deadline.
Okay, maybe there is another question. I will just read it, and whoever wants to pick it can pick it. What happens in a joint venture company where one of the partner is local and the other company is a foreign entity? Then what will be the group company policy to state? It's, I think, Uma, you covered this already, this problematic in your part, right?
Yeah, we did cover this. So if we look at the resolution, what the resolution says is that you should be part of a group where one of the group entities is outside Qatar, and then per se you should not be required to file a master file if the reference is on the group. If you look at global regulations, and Philip could correct me if I'm wrong, that usually the question there is, are you a part of a M&E group? The reference is still made to the M&E group. However, in Qatar, if we look at the executive regulations, that's the base regulations, then it is related party, which then creates a complexity. And then, of course, you will then have to see how you would, if there is no clarity, you don't want to have an underreporting, and then what you will have to see is how do you cater to these questions in the master file, and what kind of information can you best provide over there.
Yeah, I think that this will be a kind of topic of what kind of joint venture it is and who has the controlling stakes. And if it is a 50-50 joint venture with no controlling stakes, well, then would we argue that these are two independent parties that made a market pricing and a market arrangement to create this joint venture? Or is it a different status? So this is the first question. Then it is also, does this joint venture has some additional operations which are beneath it, where perhaps the joint venture would become the head of the group, and then the master file would be at the joint venture level. So I think it requires kind of case-by-case analysis and determination on what the best way forward is. Unfortunately, it is a more kind of complex environment, so there is no one-size-fits-all solution in this respect.
Okay, maybe the next question, how do you make the comparability analysis when our transactions or services provided uniquely from other companies?
I think that this is comparability analysis, or the so-called benchmark analysis that we do, depends on the type of services which is being provided. And if a company just provides services to a related company, then usually we do not have this possibility of applying the comparable uncontrolled price method, because there is no internal comparable data which is available. And then we proceed to using various databases of publicly available information. And it depends on the type of service, but usually we will take a look at the functional profile of the service provider, take a look at the broad service category which is being provided, and then start with a usually Qatari search or regional Middle Eastern search to identify companies that render the similar type of services on the open market and have a similar functional profile, which we do by assessing their kind of company descriptions, taking a look at the full spectrum of activities they perform, and then doing subjective decisions on whether they fit or not.
Okay, then another question. What if it's a case where a group of companies do not have inter-shareholding, so not common ownership in each other, but only function or operate as a group?
Well, I
And,
think
and maybe related to that, what is the definition of a group? It was another question.
I think that there is multiple relations or definitions to what a controlled entity is. You have the accounting principles, which is one, but you also have the factual control, which is where management, the same kind of type of management, might sit in different companies and influence the operations of different groups, which also needs to be taken into consideration. Uma, I know that you did the kind of presentation of the related parties. Would you like to chip in with some additional details here?
Well, I think you're muted.
Yeah. So the basically we are driven by the IS 24 here, and that would be the determining factor. The only thing is one more point that we were talking about earlier is when we talk about individuals, there we'll have to see, one, whether those payments are anyway covered under separate regulations, and whether those would be covered in the TP requirement, because there's no shifting of profits. So that is just an additional point that I wanted to make, that since there's no shifting of profits, maybe those would not be covered then.
Maybe Ramya, has the master file to be submitted for the local partner or the non-resident partner? I think that's a bit of confusion what the master file is. Maybe you can explain.
Yeah, so the master file is typically required to be prepared at a group level. And we have covered this in the sections, and it was also answered as part of another question. If the consolidation is happening at the non-resident entities level or at the local companies level, we'll have to see where it's happening, and then accordingly the master file will have to be prepared at that group or subgroup level. I hope that answers your question.
Okay, maybe we have a time for two or three more questions. So one is maybe Philip, in case a company doesn't meet the thresholds but has several IFLs with related party, is it required to file the TP declaration and documentation?
Now, that's a very interesting question, because first, on one side, you don't have the thresholds of materiality to disclose the DSCP, but then there is the second question of you have interest-free loans, and perhaps the question is, are these interest-free loans, should they have been remunerated? And should there been an interest rate which was applied? If this interest rate was applied, would it cross the threshold? So I think that just being under the threshold doesn't exempt you for doing an internal transfer pricing analysis to know whether your kind of transactions with related parties are at arm's length. And then the second part of the disclosure forms comes, what would happen if you would increase it, or would you still be if you would apply an interest rate, or would you still be under the kind of reporting threshold, and would this be picked up by the Qatari tax authority in course of an audit and kind of attacked from that perspective? I think that this is a very observable case in the Middle East, where interest-free loans were the way to go, but in a usual market practice, unless it is an Islamic kind of financing, which doesn't have the interest component, but has a different remuneration methodology, I think that the question is, why wouldn't there be a remuneration which would be applied? And this would have to be thoroughly documented.
Okay, I think we are already at the end. Maybe I will just answer the last questions. And the last question was, because it is the first year of this, documentation requirements have been introduced. The question was, do we really have to do it, or is it fine if we go with our service agreements? And the answer to this question, unfortunately, yes, you have to do it. And different to other jurisdictions, you even have to file the local file and the master file. So it's not something you just prepare and you have it ready in case of an audit. here in Qatar, you have to file it. And the master file and local file is very different from an agreement. It's really, you know, providing a lot of more information. So with that, I would really like to thank you all. I don't know how it was for you. I really enjoyed the discussion, and I'm very sure that we will have more discussions on the topic. It's not an easy one. It's a very complex topic. We have received a lot of questions. We will try to answer, you know, the ones we can see by email, the ones we had no time to answer now. And with that, I would really like to thank all of you. Thanks to the speakers, thanks to the participants, and I wish you a very good day and a good rest of the week. Thank you and goodbye.
Thank you, everybody.